Even though it is a re-up, you're still underwriting. Some of the reasons why we like it, we have a long history of investing in technology. We think that's led to a more disciplined approach. For example, you've seen them selling more companies over the last year and making investments. They've generated favorable returns. The worst fund that they have is an 11% net IRR. In particular, too, if you look at their 99 and 2005 vintages, you think of what those have. They have all kinds of peak pricing period and then the following recession. And you look at the multiples on those funds, and it's pretty impressive. The team's been stable over time. The leadership longevity on their investment. And David mentioned the sourcing model. They do try to seek those technology companies off of the beaten path that are not sought after by other private equity firms. And, New Mexico is one of their target areas as well. They've actually contacted 40 New Mexico companies over the last few years. Some of the risks that we identified in our analysis, because of the strong performance of technology, we see a lot of people going into technology right now, which is driving prices up. With JMI, they've been disciplined on their fund size. They're not trying to pursue larger deals or invest capital in faster, like we've seen some other managers do. And their strategy has been consistent of trying to be the first institutional capital. We also, the prior funds do have losses in them, which is common with the growth equity strategy, but they've had gains that more than offset the losses. Also, the last time that we presented, there was a question about fees that came up, and so I wanted to bring that up now. Specifically, the management fee is at the higher end of what you'll see us earn, and this fund also has no preferred return. So basically, the way that we look at the terms, we look at it from a holistic standpoint, and look at all the terms together. While the management fee is high, you'll see that they have an all contributions first distribution waterfall. A lot of the North American funds still have a deal-by-deal distribution waterfall. And we think that actually encourages strong alignment, because that means that they have to return all of your invested capital and all the fees that you paid to the fund before they get a dollar of share. You might get a deal-by-deal waterfall with a preferred return, an 8% preferred return, which we often see with the buyout managers, but that fund could actually collect carried interest before they do. So we think that does encourage strong alignment, and even without the preferred return. So we're recommending an up to $75 million commitment. With that, I'll turn it over to John. 20%. Yeah. We focus more on the structure and accidentally left out.
Well, good morning. Thank you for letting us present. My name is Paul Barber. I'm one of the partners. I'm joined by my partner, Susan. We're in the San Diego office. Thank you for your support for JMI 8. We just made our last investment in JMI 8. We think JMI 8 is going to be a good investment for New Mexico. The bet you're making with JMI is we are investors in the software sector. When we started the firm 25 years ago, the bet was software will win. And so over 25 years, we've been investing in growth, business-to-business software companies throughout North America. And so every year you think of our economy, CapEx more and more goes into IT. Over time, hardware gets cheaper, more and more of the values in the software. That's the world I've spent my career in. We're not in the consumer world. We're not doing games. We're not doing consumer. We're in the boring business-to-business, what used to be called enterprise software. 10 years ago, the cloud came along. And the cloud has provided a phenomenal opportunity for all of us. You think of how we use our phones, how we use the internet, the cloud infrastructure. It's provided a great opportunity for consumers, for businesses, and companies. And so today, what we're investing in are founder-owned companies, generally in secondary cities. We've not invested in New Mexico yet, but we've been here a bunch. And with the cloud, it's easier for entrepreneurs to be in secondary cities. It's cheaper for them to start a company. You don't need all the hardware and all the infrastructure. And it's easier for early companies to adopt. And so the world we traffic in are thousands of founder-owned B2B growth cloud software companies. We are not focused on Silicon Valley. We're focused in secondary cities. We've made investments in 26 states and 3 provinces in Canada. We find that the companies are more capital efficient because they're bootstrapped. They're in places like New Mexico where the costs are more favorable. People are generally more patient. And our job is to go find alignment with those entrepreneurs. Our average check is $40 to $50 million. We're often a minority investor or sometimes a control investor. And our job is to help grow these companies. We're not the startup folks. There's a lot of great managers who do startups. We're not the 0 to 10 folks. We're the 10 to 100. We help founders professionalize their teams, scale a business. And what happens at the back end are two big things. You know, strategic companies lose the ability to innovate. So technology is much like the pharmaceutical industry. The big companies don't innovate anymore. They're distribution channels. They're very good at buying. Over 25 years, 80% of our exits have been sales to strategic buyers. A few of our companies go public. But what's really changed in the last 5 years is there are now these larger tech buyout firms that buy our companies. So in the last 5 years, we've exited 37 companies. That's effectively 100% of our portfolio is turned over. This year, we've already exited 6 companies on a basis of 32. And so we scale the companies from 20 to 100. And then when we exit, we can have strategic buyers compete against financial buyers. And financial buyers move fast and are able to use leverage. So in today's world, half of our exits are to the larger PE funds. And with these cloud businesses, everyone thinks that technology is risky. But the cloud businesses are subscription revenue with high gross margin, low CapEx businesses. So when they get to scale, when you slow down hiring, they become very profitable. So we play that growth phase. Business to business, cloud software, capital efficient, secondary cities. We have a lot of people. We have 50 people at JMI relative to our fund size. We have 2 offices. Sugan and his teams are traveling all over. We meet with 700 companies in person a year to do 6 deals. So we're constantly sourcing, and we're constantly doing due diligence to find that handful of deals. And we think that the macro trend of cloud will continue. Business to business is fragmented. In the consumer world, there's a small number of big winners. Think Facebook, Google, things like that. In business to business world, it's fragmented. There's a long tail. We invest in that long tail. Most of the companies we invest in, you will never hear about. They will get bought by somebody else and get embedded in the infrastructure. So our strategy is to stay close to the same size, invest in our team, focus on sourcing and due diligence, work to find 20 investments over the next 4 years where we can run our growth playbook. And at the back end, we have lots of exit opportunities. We've had 6 exits so far this year. I think there's a chance we'll have 4 or 5 more this year on a denominator of 30 companies. What we want to do is, most of our companies have 1 act. We invest in that 1 act and then sell them to the next guy. And we want to hold on to your best ones to the end of the fund. And so Fund 8 is off to a good start. It's early, but we think it's going to have low loss ratios. It's a cloud portfolio with a 25% organic growth rate. We can keep that growth rate up for the next 3 to 4 years. We're going to do a number of exits, and our goal is to be a top quartile manager in this strategy. We have 1 fund, we have 1 firm, the economics are spread very broadly. We have a European waterfall, we have flat vesting. It's a very effective deferred comp mechanism. When I joined, we didn't get a carry distribution until year 9. And so we think we're aligned relative to the opportunity, and we appreciate the support of Pavilion in Mexico. I'd be happy to answer a few questions.
Can you just tell us a little bit more about the growth environment and how it's changed from the veteran IPO to the growth of unicorns to growth of what you call the one-act plays? I mean, how has it changed and what is it?
Excellent question. The unicorn side, you really have to segment the consumer world from the B2B world. What you see in consumers is a smaller number of big winners, whether it's Facebook, Google, the iPhone, and they're really good businesses until they miss a product cycle, and then they completely fall off. Our world is very fragmented. And so even at the peak, the top 5 vendors control less than 30% of the market. There's 10,000 business-to-business software companies you've never heard of. And what happens with the cloud is, 1, people are replacing legacy technology, the old client server, very heavy. And then there's also new applications. Think of like Salesforce.com. There's new applications that are being developed. So there's probably 10 times the number of companies there were when I started. we have more competition, but there's a lot more companies. And so what we've learned is you can't dabble in what we do. I call it the growth equity river. We have to be out in the market every week talking to companies. If you come to our office this afternoon, barely anybody's there. Everybody's out calling on companies. And so there's more opportunities. Most of these founders actually take their time before they raise capital. Raise money. So we have very long sales cycles. But then in the end, the deals happen faster. And so we have to be prepared. We have to, Sukin and our teams have to have a view of the space, a view of the company, and a view of how to value it. And that's why we think staying razor focused is the right answer for JMI.
I think another way also to just add to what Paul just said, the software's growing very quickly. Revenue in software across GDP added 22 billion last year, just in 2018. That's the expectation, and that really touches every subsegment of the economy. And so when you talk about the growth equity river, it really is every sub niche. It doesn't matter what industry, what vertical. We're seeing software opportunities in almost every place, and we have to lean forward in all those areas to really understand the end markets much better, so that way we can be competitive when we're talking to the companies in each of those specific areas.
Good, just to build on that. So if you look at our 20 companies in JMI 8 by industry, it's very fragmented. There's financial services, there's education, there's healthcare, there's some IT, but it's not IT centric. Sales and marketing, think of all parts of the business economy are getting automated.
You know, if the average life of a public company today is 20 years, which is really shocking. What's happening when you're selling out to other private equity firms? Are they getting the subsequent tranches of capital to sustain growth in the way that public markets used to sustain growth?
So there are other people here who may be better at commenting on this than me, but certainly in the tech sector, when I was the predecessor to JMI was the investment bank Alex Brown. We took Microsoft public, Oracle public, a lot of the great companies in the 80s and 90s. We used to take companies public with $100 to $300 million market caps. And if they got to $1 billion, that was a big outcome. In today's world, sub-$1 billion has been consumed by the private equity. And so what we do is sell to, there's a list on one of the pages here of all the big private equity firms who bought JMI companies. And generally what they do is take less of a growth orientation and more of a profit orientation. Because it's recurring revenue, they're very stable businesses. So there's, in our world, about 20% of the companies that used to go public are now owned by these bigger PE funds.
Thank you.
Yes, Linda.
Will blockchain be a big opportunity?
That's a great question. Thanks for asking it. Blockchain will get embedded just like wireless gets embedded. So anytime one of these big horizontal ideas comes out, that is not what we do. There are people in Silicon Valley who will bet for the moonshot that blockchain is going to change the world. What we'll look at is a third-party logistics software company that's been using software to help logistics happen. Well, all of a sudden, blockchain could be embedded in their solution to help do it more accurately. So it ends up just like wireless gets embedded. A lot of those horizontal technologies get applied, but you won't see us being the moonshot people. And there's been every 5 years there's some buzzword, technology horizontal thing that comes out. And how we look at it is how can it in the healthcare world, like there'll be benefits to healthcare payments by embedding blockchain, but you'll never see it.
Other questions? Yes.
Thank you, Mr. Chairman. I guess this is more for Richard, but the answer as well. I just noticed that your initial capital commitments when you started the firm was by John Moore's.
Correct.
Is he still investing?
Correct. Yeah, the family still does.
Yeah, that's good.
Yeah.
And then one of the last thing that I had here was your partnerships with Herman and Friedman.
Yes.
Can you go into that a little bit more?
Sure.
And then can you tell me the difference between the performance of the partnerships with Herman and Friedman versus just JMI?
Good question. So I'm really proud because Sukin used to work at Hellman Friedman. So Hellman Friedman is one of the top firms. And when I was at Alex Brown in San Francisco, I ran the software banking practice. A number of the partners there are personal friends of mine. And I got to know them when they had never invested in technology. And I was trying to convince them in 1997 that software companies didn't have risk. I joined JMI in 1998. 1999, Blackbaud came up for sale. Blackbaud's the leading provider of software in the not-for-profit industry. It's a company I knew well in Charleston, South Carolina. 90 million of revenue, 30 million of profit, owned by a British guy. He wanted to sell us the company and leave. And Hellman and Friedman couldn't figure out how to value that. And I said, this is a great business. They own this market. Let's buy it. We paid 8 times EBITDA, 50% equity, 50% debt. That was the first software investment H&F ever made. Our partner, Bob Sawalski, went in and became the CEO. The next year, Mitchell International, which happens to be in San Diego, came up for sale. The CEO was also a former client of mine. They're in the collision repair claims business. So we invested in that. So the first 3 or 4 investments were all companies we had a direct relationship with. They never needed our money. When I loved Warren Hellman, he was a great influence on me. We tried to have the same culture at JMI. And his view was, if there are people who can help us take out risk and help us make better decisions, we'd like them to be at the table. So over 20 years, we made 10 investments with Hellman Friedman. That index has returned kind of 4x capital. We've never lost any money. Today we have 2 investments, Chronos and Applied. Along the way, we were fortunate enough that Sukin had worked at Hellman and Friedman, went to Harvard Business School and worked at Google, had more of an interest in the growth side of things. And so Sukin and I work with Hellman and Friedman quite closely. So over 20 years, we made 10 investments. There's no contractual relationship. We've worked on a lot of things that have never seen the light of day. And one thing I learned at Alex Brown was you want to work with other high quality people. And I think JMI is very good at what we do. There are other people who are good at what they do. And sometimes we compete and sometimes we work with people. And Warren always said, you want to wear the white hat. So I think if you talk to anybody at Hellman and Friedman, we help them take out risk and have added value to those companies. It isn't about the capital. And we've worked with a number of other GPs over time. And I think going forward, half the time we're by ourselves, half the time we're with another GP, but we're going to always be in a place that's a good fit for JMI.
To illustrate that too, even though they're not a large equity percentage of the Hellman and Friedman deals, they're usually involved on the boards.
I'm always involved in the board.
Actively involved in the company, even though they are 1 or 2% or so.
All those companies do acquisitions, and those are the kinds of companies we track. All those companies need to hire better people. In the software industry, you don't hire people from GE to run a software company, nothing against GE. You hire people from the software industry. We made 140 investments. We've had 100 exits. We're looking at all these companies every day. So when there's opportunities for those H&M portfolio companies, we can add value by bringing those relationships and those ideas.
Yeah, I think that's a great data point, that they're on the board with such a small equity ownership. It shows the value that JMI brings.
And for perspective, Hellman and Friedman is a large buyout firm. The next fund that they'll raise is $15 billion. So you're talking about different check sizes, but you're talking about tapping into certain expertise here.
Are we ready?
Okay. I do want to remind everybody that this investment meets the policy that we have established as a council. It meets our strategy, it meets our plan. It has been due diligence by both our consultants as well as in-house. And it has met this, as Richard has said, it goes through the same underwriting as if it were a brand new investment, despite the fact we do like to keep repeat managers. So based on all of this, so based on the recommendations of the Council Investment Committee, Private Equity Advisor Pavilion, SIC staff, and the General Fiduciary Oversight of RBK, I move that the State Investment Council approve the $75 million commitment to JMI Equity Fund 9 LT, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
Thank you. Any other comments, questions? All in favor? Aye. Any opposed? Aye. Thank you, Tim, we got your vote. And, yeah, unanimous approval. Thank you very much.
support. Thank you very much.
Paul, that's,
Good morning. I'm joined at the table here by the Blackstone team, Angela Concia from Blackstone Energy Platform and Robert McMullen from the IR platform. And I've got Alan Waldrop from Pavilion next to me here. Just, you're used to seeing me with the Townsend team here, and Townsend does consult on all of our real estate, timber, ag, infrastructure funds, and some of our energy funds where they're midstream focused. But where there's a strong component of upstream, we have Pavilion underwrite these investments for us. So that's why Alan's here at the table with me. But we do rely on Townsend's pacing model for our investments in the real asset space. Townsend, their pacing model calls for $200 million a year of new commitments. That would go across the platform, infrastructure, energy mostly. We're probably full right now, relatively on ag and timber. So the focus is really on energy and infrastructure investments. To date, SIC has approved $175 million of commitments in the space. There was a Macquarie Asia Infrastructure Fund earlier this year, $75 million. Blackstone Infrastructure Partners, which is still in the closing process, $100 million. So this $50 million commitment to BEP3 will actually take us slightly over our pacing model, but we're not terribly concerned about these things. They tend to be sort of lumpy. In terms of our relationship with Blackstone, in real estate, we've got about $200 million exposure with Blackstone, and in real assets, it's about the same. That's a total of about $400 million. In addition, Blackstone acquired the Harvest platform. Harvest is our manager for our equity portfolio. Excuse me. So our total exposure is really $800 million with Blackstone. None of that violates any of our concentration limits. So I'm going to let Alan talk about Pavilion's view of the fund, and then we'll turn it over to Angela to discuss the strategy and the differentiating factors of Blackstone.
Great, thanks, Paul. I know you all have our detailed memo and Blackstone materials, so I'll be brief. As Paul mentioned, we're recommending up to a $50 million commitment to Blackstone Energy Partners 3. Paul noted the existing relationship you all have through real estate infrastructure and the prior energy fund. Just as background on the fund, they're targeting $4.5 billion of commitments to invest in global energy businesses. As background, Blackstone's a large publicly traded asset manager. You've heard their story before. They have a strong energy space. They've invested $15 billion in energy since 1997, which has generated a 3.3 times gross multiple and a 42% gross IRR as of December 31st. Looking at funds 1 and 2 specifically, fund 1's at a 1.5 times multiple and a 13% net as of December 31st, and fund 2 is at a 1.1 and 9.6 net. Important to note, fund 2 increased to 13.2% in Q1. And you may have noticed in the materials, there's a fairly large gross to net spread in fund 2. That's common in energy businesses in general. And I think compounding that in Blackstone's cases, they were very tactical and opportunistic, and that's one of the things we like about deploying the capital. So they may commit to new investments, which are then funded over time. So they may commit $500 million and invest $100 million of that in the first year. And so that slower deployment really creates a fee drag early in the fund's life. But as we saw in Fund 1, Fund 1's gross to net spread is about 4%, 4 to 5. So we expect that to narrow over time, and it's doing that. In addition to the strong performance, just in regard to the other merits, they've got a deep and experienced team of 26 dedicated professionals. They've got access to the broader Blackstone platform. They've got a very strong reputation in the market as a sophisticated energy investor, and that really came through in the reference calls we did on this fund, and as well as our work on the prior fund. And they have a differentiated approach, which we think works well in what has become a very dynamic and rapidly changing space. The energy world seems to be, the price cycles seem to be compressing, they're getting, the waves are getting greater and closer together. So having someone tactical is important. In terms of the risk we identified in our memo, they were focused around a couple of senior level departures. Actually, one of those was a transition to the infrastructure team, so it still works with the energy team, and still with the firm, and another was managed out, which is turnover we like to see. We like to see them focusing on making sure people are productive. There have been limited realizations, but that's largely due to the energy market. One of the benefits of being in the energy space on the private side is that you don't have to sell when prices are low. So you can pick your spots. You can buy when they're low, and so they've held things as prices have recovered, and we expect they've had a number of exits already, and we expect the rest of this year and potentially the next as prices hopefully hold for a bit to be big years. They are investing sometimes in places with more volatility outside the U.S., and they're concentrated in the energy space, which can bring increased risk. But as we've seen, they've done an excellent job of managing their downside with minimal losses to date, which when you think about the cycle they've invested in over the last, say, 10 years has been impressive. It's been a very volatile time in the energy space, and lots of people have lost large amounts of money, and they've managed to avoid that. So with that, I'm happy to take any questions, otherwise I could turn it over to the Blackstones.
Mr. Chairman, could I ask, especially about risk?
Sure.
I noticed that in here you have a comment that the full life cycle has been unproven. And I was just wondering if other funds have a more established performance record that we should be looking at as well.
Yeah, so let me clarify that comment. We're commenting about Fund 1 and 2. Blackstone has invested through their capital partners funds in energy businesses. And and when we say full cycle, invested in and realized and been through kind of an up and down energy cycle. So they have as part of the Blackstone complex, but Funds 1 and 2 are largely unrealized. So we just wanted to point that out, that while they've made the investments and they're performing, they haven't yet been fully exited. You do have relationships with other folks like NGP that have been around a long time, with NCAP. Those firms have been around a long time. Their most recent funds are also heavily unrealized, but they have a lot of prior funds that are fully realized. And so that's the nature of the comment.
Just to follow on, if I might, if I read this correctly, Blackstone created the energy platform because you'd exceeded your concentrations in capital partners, and now you're splitting 60-40 the deal flow. Could you just explain that a little bit more?
Sure. So maybe just back up for a second to have context. So thank you for making the time to see us. My name is Angelo Consi. I'm a partner and one of the founding partners of our energy franchise. I've been with them for 14 years. So maybe specifically to your question, we founded Blackstone Energy Partners 1 in 2011, where we were investing in energy, and our LPs came to us and said, "You have a best-in-class track record. We'd like to help enable you to invest more relative to the allocation in our main energy fund." And as was mentioned before, we've been investing in energy since 1998, but out of our main private equity fund. And so we, with the support of our LPs, and actually with the really proactive provocation of our LPs, founded Blackstone Energy Partners 1, and that was on a 50-50 basis with Blackstone Capital Partners 6. We then invested Blackstone BEP 1 from 2012 to 2014, and then raised Blackstone Energy Partners 2, which you all are invested in late 2014. And that had a 60-40 split with our main private equity fund. We've invested that fund over the course of the last three or so years, and are now raising Blackstone Energy Partners 3, which will have a 60-40 allocation with our main fund, probably moving more like 70-30. That's a natural evolution in terms of the fund size of Blackstone Energy Partners growing, while the general size of our private equity fund staying relatively low. Does that answer your question?
Yes, thank you.
Yeah, and just to add a little more context, generally, most of the generalist funds have sort of either formal or informal limits on how much they would like in a certain industry. And so as they saw a lot of opportunities and they were doing really well sourcing, there were just more opportunities than they could fund out of the main fund and feel comfortable. They didn't want the main fund to be 50% energy. That's not what the LPs had signed up for in that fund.
Okay, other question? All right, proceed. Yeah.
Great. Well, thank you again for your time. And maybe just to take a step back, we at Blackstone greatly appreciate our partnership with you across all verticals. We look at it as a partnership and a long-term one. And hopefully you've seen that, and you have seen that across the various verticals. I'm here to speak specifically at Blackstone Energy Partners 3. We appreciate your support on 2 and look forward to hopefully your support on 3 as well. What I thought I'd do is when you think about an investment in Blackstone Energy Partners 3, there are really 3 or 4 lenses through which you're probably thinking about it. 1 is an investment in Blackstone. 2 is an investment in the energy sector. 3 is an investment in our team and our investment process and our track record. And 4 is an investment in the outlook for energy over the next 3 or 4 years. So let me touch on those very briefly at a high level, and then we'll open up to questions. From a Blackstone perspective, I've been with the firm for now almost going on 15 years, and it's really, I think, demonstrated itself as a leading global alternative asset manager with offices around the world, with a rigorous investment committee process, who have been great stewards of capital over time across our verticals. Really, and the backbone of it is cultivating, managing, mentoring really high-quality individuals. And that's why I think Blackstone has been successful in continuing to generate attractive investment returns across all verticals. And within the energy sector, we benefit from that, from a brand, from a reputation perspective, from an investment rigor perspective, and the network that creates. And so I continue to see Blackstone opening doors across all verticals and then specific to energy. And I think its investment track record across the 3 or 4 different verticals that you're invested in hopefully kind of speaks for itself. Specifically in energy, why energy? And I have this debate with my wife quite often. And the genesis of it is there are 5 or 6 different aspects to it that excite me and make me excited about where energy is going and our investment approach to energy. First is it's a hard asset class. It's not reprogrammable and it's hard to move. And so that carries with it benefits through the cycle and a veil of stability. Secondly is it benefits from inflation. And it's a natural inflation hedge. 3 is it's a very large sector. It's $5.1 trillion of market cap when you think about the global nature of the industry across sectors. And our mandate is not just North America, and it's not just one sector. It's a global mandate across sectors. So why does size matter? It means that we can be highly selective and very narrow and pick 1 or 2 investments a year out of a $5 trillion market cap industry and generate significant and outsized returns. The 4th aspect of it is there's some degree of volatility, and we look to mitigate that from a risk perspective, but we look to be opportunistic on that in terms of how we get out our investments. So we're very selective and patient as to how we invest our capital and when we invest our capital. So specifically, in the gas sector, which is the sector that I oversee, we sign up over 120 CAs a year, and we probably do 1 investment. It's a lot of effort for just 1, but that 1 is cultivated out of a very large cycle. And I think the last aspect of it that I think is understated and is very powerful is technology. Technology is changing this industry in each of the various subsectors. It's improving returns on capital, and it's not a technology or a mindset that's available to everybody. It's the best-in-class managers and best-in-class teams have the ability to generate outsized returns through the use of technology, and technology moves forward and tends not to move backwards. So there's a lot of wind at our back in terms of what technology is doing in the energy sector, and I think that we are well positioned to be able to exact that. So I think energy overall is a complex, a diversified industry, one of scale, with the ability to attractively and selectively identify investment opportunities, exit them through various different avenues, and then benefit from the technology is an attractive sector. When you think about Blackstone Energy Partners, so how do we invest in that sector? Well, we have a diversified footprint across upstream power and midstream renewables. We have a global mandate, so roughly about 75% of what we invest in is in North America, but the rest is all international. We invest in upstream, we invest in midstream and power through the cycle and selectively. So we're not always investing in one of those cycles. So a diversified footprint. I think our track record has demonstrated itself to be top decile. So we through the course of our longer term track record since 1998, we generated a 34% rate of return. BEC 1, as of this quarter, will probably be around a 15% net return. BEC 2 will be at a 14% net return. And if I had to kind of prognosticate as to where those funds will get to, BEC 2 will probably be in the mid-20s. Feel really good about BEC 2. It's been a year or two that's, in terms of its vintage, it's a little earlier, but it has all the makings of a home run fund. And those investment returns are 1,000 basis points plus higher than the relative industries. The most compelling part, I think, of what we've been able to do is to generate those sorts of returns without a material loss. And when we went through the downturn from 2012 to 2014, oil prices dropped and gas prices dropped. We didn't have one liquidity event. We didn't have one covenant issue. I don't think we fired one employee, and we didn't have a material loss. And the reason why that is because the investment strategy we have is we generate returns. We seek to generate returns through the things that we can identify, control, and influence, and use those as the return, as the momentum for returns. And that creates also a margin of safety on the downsides, commodity prices decrease. So said more simply, we seek to increase the return on capital from each of the investments we make through the things we can control and influence. I don't like to be dependent on things I can't control. I like to be able to drive things we can control. And that, in a mid-cycle environment, can generate high teens, low 20s rates of return. In an inflationary environment, as we have today, it should be able to generate mid-20s. And in a deflationary environment, we should be able to generate high single digits, low double digits type of rates of return without material loss. That margin of safety, or the investment mindset of protect your downside and your upside will take care of itself, is very important to how we invest. And BEC 1 and BEC 2 are a good example of that. So BEC 1, again, 2012, 2014 vintage didn't have a material loss, and that portfolio will end up around 15% net, which will prove to be a top decile fund. And BEC 2 will be in the mid-20s. So that's kind of the investment strategy, and we really exact that through through Blackstone being the investment process, the team, the network, the brand and reputation, and then for our team. We have a group of 31 individuals who, when you tally it all up, aggregate over a century of investing experience, where the senior level of the individuals, myself and Dave Full and others, have underwritten 90+% of the investments that we've made to date. It's through a process of cultivation and mentoring and being at the firm over a long period of time that we've honed that team. And we look to invest across sectors, across geographies, proactively and selectively identifying investment opportunities. So that team has stayed relatively constant, and the key decision makers have stayed relatively constant during my tenure at the firm, and really set the foundation for being able to exact the investment strategy we've had and the return and the investment returns that we've been able to generate today. From an energy outlook perspective, I think it's a really exciting time to be investing in energy, and it's partially because of our dichotomy, for the reasons why I mentioned before, but also where we are today, where we're at or near mid-cycle pricing when you think about oil prices and gas prices, but we're at near trough levels from an asset perspective, and it has to do with a couple of microdynamics within each of the oil and gas sectors and the midstream sectors. Power today domestically is I'd say fairly valued, but we see over the course of a cycle, and we think longer term, 3, 5, 7 years, it'll generate some really interesting investment opportunities when we're looking at things more internationally. So we're at a point where it would be the OPEC announcement, which added another veil of safety to oil prices, or within a range, or where we are on natural gas prices. When you juxtapose that relative to asset prices are depressed. That creates a really interesting environment for us. And when you then back that up with the macro overlay of we're in a period of global economic expansion, and energy asset prices and commodity prices tend to benefit from that global economic expansion. Number one. Number two, we're early in an inflationary environment. Both of those add a significant amount of macro tailwind to where we are in energy, with the benefit of, with the microdynamics in each of the sectors, are really interesting at that time to be able to aggregate and exit some of our investments. We're complementing that by monetizing our investments today. We announced the monetization of one of our companies in BEC 1. This is a month ago, and what we try to do is try to conservatively mark our investments. It's one of my personal philosophies of under promise and over deliver. So the investment we monetized was called Royal Resources, or been looking to close the next couple of months, and we had that marked at 2 times, and the transaction that we've been able to negotiate values it at 2.5 times the money. with the potential to earn 2.9 and 3.5 times our money through 2 earnouts. So I give that to you as an example of one, we're actively monetizing, number one, and number two, we conservatively estimate our mark-to-market valuations. So in a nutshell, why Blackstone Energy Partners? Because we have a global investment mandate. We're a diversified investor in energy. We have a best-in-class team. We have, I believe, a top decile investment track record where we've been able to generate returns and excess returns through the things that we can control or influence, which provides the ability to make really attractive returns at mid-cycle or through an inflationary environment out there every day, and then also provide a margin of safety to mitigate losses. And that combination of the two, managing our losses and generating attractive returns, is really the hallmark of what we're looking to do. So very much appreciate your time, and maybe I'll open it up to questions.
Terrific, thank you. Other questions? I know you spent a lot of time at the investment committee. Yes.
I can't help but ask a curiosity question. We just invested in Blackstone Infrastructure. And, you know, I think that some of their assets is similar to yours in that they're large, long-lived, et cetera. They chose an open-ended fund, you're a closed-ended fund. You're a deal-by-deal waterfall, you're doing something different. How do you think about structure within Blackstone, both in terms of the assets you're managing and how it relates to your investment partners?
Yeah, that's a really interesting macro question.
Yeah, sorry.
No, it's a good question. I think the Blackstone Infrastructure Partners, and we appreciate your support on that, is really a mandate to invest in infrastructure assets, some of which are in energy, but generally expected to be less than 20%, with not a lot of overlap, because we see those as being highly contracted, highly stable assets that have 10, 20-year plus type durations. And so when you think about the asset duration and investment duration, it's important to be able to match that with a fund duration. And it's very important to us in the energy sector to be able to do that, because we're investing through cycles, we're longer-term investors. Now, our investment time horizon is not 20 years or 30 years. We look at an investment time horizon as being 3 to 5 to 7, with the potential to need and want the ability to invest over 10 to 12 years. And so the investment structure is really by virtue of the target investments and their duration, and the two are very different. Does that answer your question?
And our infrastructure fund, as you heard when Sean Klimczak came out here, they fully intend to hold part of their portfolio 10, 15, 20 years. And the only way they can do that, as Angela alluded to, is by having this longer-term open-end structure. Now, we also had to, in that longer-term structure, provide some liquidity mechanism. So that's why after 6 years, there are ways for LPs to get out. But it's not the closed-end structure that we set up for this and our private equity funds, again, to focus on these 4 to 7 year kind of average durations.
And do you get pushback from people like us on deal-by-deal water flows or waterfalls, or not?
I'd say generally speaking, not, because it serves to strengthen the alignment of interest. And so I look at it in terms of my personal alignment. I'm invested in the funds personally. I'm invested in the general fund carry. I'm also invested in the general funds, the private equity funds. And then also I have deal by deal. But the majority of my economics is through the general profits of the private equity fund and the energy fund, and so are not deal by deal driven. So we've seen it as being a powerful incentive to, especially more junior team members, to be more entrepreneurial, to be able to be rewarded for their efforts, and to be able to drive more of a meritocratic culture, while not changing the alignment of interest at the senior levels. And that's where also the investment committee comes into play, because the investment committee, generally speaking, has a number of different forms of compensation, one of which is in the firm, and the carry in all the different funds. And so when you look at the different lenses through which investments are made, the firm, the investment committee, the senior deal professionals, and deal team, when you wrap it all together, that alignment all kind of works, we think works well. The deal by deal was more to incentivize the junior team members to be more entrepreneurial and to be rewarded for that.
Not so much through distribution of carry, but through incentive bonuses?
Through incentive bonuses, through stock allocation, we've used 2 or 3 different ways to incentivize that. But look at that as a package. That's a really good question.
Thank you.
Yeah. Are there any other questions?
Just a couple. Your statement, I think Angelo said that you have a best of class team. And I guess that boast would come better if it came from Alan or Paul. But
Well, we would
Don't you
agree
think
with
we're
that. I mean,
best
I met a bunch of the team members and I met Angelo and David Foley in New York, and I've worked with several of the people there, and I've told this in the Council Investment Committee, but after the due diligence day that Blackstone held in New York, I ran into Steve Schwartzman, the founder of the firm, and he said, Paul, we recently advertised, I'm gonna have the numbers off, but order of magnitude, this is right. We recently advertised for something like 30 analyst positions, and we have 15,000 applicants that I maybe got from that. But they really can pick from whoever they want, whatever universities they want. They can get the top few people from every school, even Queen's University. So.
Which is my alma mater. I'm a Canadian by background as well. I'd say the specific comment, maybe to put that more pointedly, is I'm very proud of my team. So you can take me out of that. You can form your own views. For Bill, you can form their own views. I think I'm just really proud of the individuals that we have. They're good people who are hardworking, who want to learn, who want to grow. And I had the benefit of recruiting across different firms. And so we've tried to pick over time. And so take that as me being proud, not necessarily boasting about myself or other senior level people in the firm.
all right, I just thought it was kind of amusing. And really, next question, really for Vince or Paul, is this will move energy into our largest percent investment into the real asset portfolio. And even though it's less than the 50%, it'll move it up somewhere between 34, 35%, something like that. What is your expectation on bringing further energy recommendations into the portfolio? Are you basically comfortable at the level we're at? Or are you thinking you're going to increase, make further recommendations on energy? Just kind of following up on some of Land Commissioner Dunn's concerns.
Sure, I'll let Paul speak to individual investments, but policy-wise, the cap's 50%, so if we think we need to use that, we will, as deals come along. I get the energy question, the Commissioner Dunn brings up almost every time we bring in energy investment. And I usually answer it like this, that the exposure to energy that we have from the inflows is really the intersection of price and quantity that gets produced, plus the deal that the land use cuts for us, with the energy producers. This is a whole different thing. So this diversifies our exposure to energy. These investments diversify our total exposure to energy. And second, look at the returns. Just grab your last quarterly report and look at the returns from the energy sector. They've been very good.
Well, given the real asset portfolio, would you, which portion of the real asset portfolio do you expect to continue to grow?
Yeah, both infrastructure and energy. And Paul went through that with the infrastructure study that we did a couple months ago.
So primarily just do those two then?
Yeah, it just, remember, Austin, it just so happened this year, we've sort of got three main energy strategies: Blackstone, NGP, NCAP. They all came out with REITs this year, and so, well, in the last 18 months. And so we've committed to all of those. I don't expect that we'll be doing so much energy next year. Now, we do have one debt fund that we're looking at, that's energy debt, EIG, which is also an existing manager. Al and I are going to be talking about that right after this meeting. But we've got another bucket to put that in. We created this financial asset bucket that we can put that into. And that was intended to invest in debt that was where the underlying collateral was either real estate, infrastructure, or energy. So we're going to talk about that. You may or may not see that. But I think our focus is really going to be infrastructure when I look at the capital that we have for the coming year. Some of them are going to come in kind of an energy wrapper because we've got a lot of these so-called energy funds that are really heavily oriented towards power generation. They may have a wind, solar, renewable strategy. They may have midstream strategies. So the E&P piece of it is actually relatively minor in our, well, not mostly minor in our portfolio. But it's it's not a huge exposure. It's about a third of our energy portfolio is in E&P.
Why did you, or how did you come up with a figure of about 50 million? I mean, why, just being the comfort level with that, with Blackstone?
No, I would have wanted to do 100 million. And, you know, we're a little constrained by our pacing model, and, you know, we want to continue to invest with the managers that we have relationships with, and, but personally, I'd rather be double that.
What's Alan's perspective on that?
You know, on the real asset side, we rely on Townsend's pacing model. And so in terms of the sizing, I mean, we would be comfortable with a larger commitment. You did 50 million last time, Blackstone's very institutionalized and proven. So we'd be comfortable with more, but that's generally a discussion between Paul and Townsend in terms of how much to pace on that side.
And we're actually working on our pacing model to, you know, because I think our internal concern at the staff level is that Townsend pacing model isn't necessarily going to get us fast enough to the 12% allocation that we have for the real return portfolio. So Alan's firm is going to look at our pacing model. We've got Nino internally is looking at pacing, and we'll be, you know, having a conversation with Townsend to see if that's the, you know, if we've got the right pacing for our real return portfolio.
So just a little more color there. The pacing that Paul's talking about is for 9% of the portfolio, not the whole 12% allocation, because we've got that financial assets piece. So we can get you to the top number a little quicker because of that financial piece. We can go find a debt fund or something that fit in there and get almost instant exposure. So we've got a little more flexibility there. But we do think we're maybe shooting a little bit low on the real asset side, and we're reviewing that.
Did I read somewhere that you could top off later with a little bit of an interest charge?
With a what charge?
Well, generally, if you come in,
Interest.
if you come in late, you know, not in the first close, the subsequent LPs tend to have to pay interest to the existing LPs.
So if we went in at 50 and I changed our pacing model and said we'd like to do a little more, we could do that?
Yes, and that actually can be advantageous, you know, because you can actually get in and pay like an 8% return to the existing investors. And maybe you're in a fund that's going to generate a 20. Yeah.
Just being efficient,
Yeah, right.
Mr. Chairman.
Okay. Are there any motion made? We do not yet have a motion.
Well, I would just suggest that when a motion is made, that maybe the motion gives staff flexibility to increase that. You know, whatever staff might be comfortable. So, I mean, we got 50, we're recommending 50.
So,
And I would just suggest maybe the motion ought to say between 50 and 100, depending on staff's.
judgment.
As
Yeah.
long as Blackstone doesn't object.
I like that amendment.
I second
We're
that.
having same discussion, so. I like the idea of bigger pieces, but obviously it does have to fit with our risk profile and our pacing model, but bigger pieces are better than small pieces. And we are 24 billion almost, pretty close. So 50 million starts to look pretty small. So the language would be, Terry, you can handle the language change.
I'll figure it
Linda has it, okay? Go ahead.
Based upon the recommendations of the Council Investment Committee, Private Equity Advisor Pavilion, SIC staff, and the general fiduciary oversight of RBK, I move that the State Investment Council approve a $50 to $100 million commitment to Blackstone Energy Partners 3 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Is there a second?
Second.
Lee has seconded. Any other discussion? All in favor?
Aye.
Are there any? Aye. Good, Tim, thank you. All right, passes unanimously. Thank you. Thank you very much.
Thank you very much. We appreciate your partnership.
Okay. Thank you, Lee. Next item will be annual investment fund. Thank you. See you later.
Yeah, well, okay, well, thanks, Mr. Chairman. So in your book, you'll find the most recent annual investment plan. We came to you in August of 2017 with the fiscal year 2018 plan. Here we are in June of 18 with the 2019 plan. As you recall, we've been writing this since 2013. Well, it's the fiscal year 2013 plan. We wrote it 12, talking about 2012. So several years now, we've been writing this. You won't find a lot of difference from last year's plan, and that's good. This is a 7 to 10 year plan and review and plan. So year to year, big changes you should question. So you'll mainly see this thing more than next step changes. But let's start, if you would, on page 279. This is the late cycle report that we delivered to you just a couple of months ago, a month or two ago. I think we're shifting into late cycle, and the reason we're starting here is because this year's morphing. That's the plan. We think we've moved into late cycle. You heard that report last time or time before, but I just wanted to review very quickly the main changes that you'll see in the plan all total. So take a look at that table. That just sort of shows you where we think we are in the economic cycle. Mainly shifting to late cycle. Last year when we came to you in August of 2017, all of those blocks were either in mid-cycle or early. The inflation pressure was still in the early cycle. The central bank policy was still in the early cycle column. The others were in mid-cycle. So over the last year, we've moved into that late cycle column pretty strongly. Economic growth very much is strong and plateauing. In fact, we think the potential of the economy, and they're mainly backed up by our advisor, macroeconomic advisors. We think the potential of the economy is about 2.5% or about 2.25% here in the U.S. We might get 4.5% with the June GDP numbers on an annual run rate. So we're at double over what we think the long run potential of the economy is. We mainly drive that long run potential of the economy from growth in the workforce and growth in productivity. Those two things together, we think will be about 2.25%, or are about 2.25% on the run rate. So right now we're at a double over that on a 1 year run rate. So very much late cycle, very strong economy, probably plateauing here, heading down as we get later into the year. Credit growth still very high. Interest rates relative to investment opportunities in the economy. There's still a big spread there, so people are still borrowing money to lever up investments. We've seen the central bank start to tighten. We've gone from 0 to 2% on the short end, so very much a mid-cycle moving to late cycle move. We think the Fed still has 2 or 3 tightenings to go. The Fed thinks the Fed still has 2 or 3 tightenings to go, according to their latest communique. So that block in the next quarter or two, we might be moving into the late cycle if they follow through on the increases that they've been talking about. Inflation pressure has been different this time. Inflation is not showing up in consumer goods or the CPI that we're accustomed to seeing when we monitor an investment cycle or an economic cycle. It's showing up in financial assets. So stocks have gone way up. Real estate's gone way up. Bond prices have gone way up. Interest rates way down. We've seen money move, and the main reason is because the Fed pushed short-term rates down to an intolerably low level for people to hold cash, so they moved it out into the most liquid part of the economy, which is the financial market. So that's one of the reasons we've seen such great returns from our stock portfolio, and just about every investment that we've made has had a big push in capital because rates at the low end were intolerably low for people to hold cash. Now that's changing. We're at 2% now on Fed funds, headed higher. But still, most of the inflation has been in asset prices, not so much in consumer goods. That's changing a little now. We're seeing inflation levels rise, but no one is really concerned that the level of runaway type inflation, sentence type inflation, And in fact, I think in the next few months, maybe it's next month, Charlie, that we'll be talking to the IPOC, specifically about inflation management to comment on that. So we'll make sure you all see the comments that we're making today. Volatility we've seen pick up, risk appetite is still high. In fact, we could probably move that over in the late cycle. Liquidity is still very, very high. In fact, we track the Chicago Fed's financial conditions index. Financial conditions right now are as loose as they've been the whole cycle. So all the way back to the second quarter of 2009, when we emerged from recession to today, financial conditions are as loose as any or at any time during that time frame. So still very loose. That indicator's starting to bottom a little bit. It bottomed a little bit in the last quarter of 2015 and the first quarter of 16. We thought maybe we'd start heading up, but it just kept going lower. We're bottoming again. We think this probably will be the bottom, and the liquidity will start to tighten. But that's probably a multi-quarter process, at least 2 or 3 quarters before we'll see any meaningful change in that index, I think, just on the way it's acting. Yield curve's very flat. Fed's fixed now, short end. And asset valuations, well, we've been sitting here talking to you about them since 2014 when the Shiller ratio went over 25 times. That historically, over the forward 10-year periods, meant low returns for the stock market. But we crossed that. It's only gone higher. We're at 32 now, almost a record level in stock valuation. So very much moved toward late cycle. That's the big change, if you want to call it a big change, or it's really the morphing of this report this year is that shift to late cycle and some of the things that means for us. So if you would flip back to 260, and you can look at some harder numbers. Yeah, so there's our main forecasts in that table. Not a great deal of change from last year, mostly lower by quarter point, half point in some places. There's real GDP, 1.25% to 2%. We think compound growth over the next 7 to 10 years. That's lower than the 225 that we think is long run capabilities of the economy, mainly because we think there's a recession there. And that's not a hard call. 95% of the time there's a recession in 7 to 10 years. Period. This last 7 to 10 year period, that's not been the case, however. So we think we're overdue, and we think it'll happen. So our numbers are a little bit lower than we think the long run potential of the economy is. That should hit the range of 0 to 3%. We think on a 3-year moving basis, we should see times when we're up to 3% on a 3-year basis now. We're approaching 3% on a 3-year basis now with this latest run in the economy. So we're right at the top of the range right now. We think we'll fall back down into that range over time. Inflation we still see as being sort of normalish to below average. Price increases in consumer goods. We think we'll actually get a deflation in particularly equity prices, but in investment prices generally for a short period of time, I think during that period. But we should still see positive inflation in the real economy or consumer prices. That leaves us with nominal GDP, that third line down into the compound column on the right-hand side at 3.5 to 4.5. That's not enough. Corporations tend to need about 5% nominal to keep their top lines growing and generate the few cents of profit on the bottom line, which the stock market capitalizes it up to stocks. Said that a lot. That's too low for companies to consistently keep those revenue streams growing. That's a concern for stock prices. That leaves us at around 5.5% on stocks, we think, next 7 to 10 years. That could be high. Our Shiller work tells us there should be 0. I don't think it would be half though, but we think 5.5. Normal is right beside it there, 9 to 11. Longer run, RDK is setting around 7% on stock. So this next 7 to 10 year period is going to be pretty tough, we think, in the stock market, both relative to history and relative to our longer run assumptions. With bonds about 3%, that leaves a 65-35 mix of stocks and bonds at about 465. That 65-35 mix of stocks and bonds is roughly the risk level that public funds, large public funds in the country take. It's around a 13 volatility. That mix is. That's why we use it on here. So you can the median public fund, we think, is probably around 5.25. They take a little bit more, we take about that much risk plus a little bit of alpha in their portfolios. On average, we think they'll earn just a little bit more. Typically, they'll earn a little bit more than the 65-35 years. People have 7.5 plugged into their models, pension funds do. If you've got a 7 plugged into your model, into the intergenerational equity model, we think we hit that 7 over the long run using RBK's long run numbers. We show you that every time we do an asset study. In fact, we show you that every year when we update, when RBK updates their assumptions. But we think in this next period, you can underperform that 7%, primarily on the stocks. Now, we reduced those, and we're going to take a look at that and try to put money in things that'll do a little bit better. And we're also going to show you in a minute if we get that recession, if we do get a downswing in prices, how we'll take advantage of that to try to get you closer to 7 in this next term. But I think you can underperform it. Even in the long run, I think we can still get it. Let's move over to 262 and take a look at how we've shifted assets sort of based on what we've been seeing in the market. If you drop down to the table near the bottom of the page on the left-hand side, you can see our target allocations or your target allocations back to 2010. So 2010, very top-heavy in U.S. stocks. And really not a bad time to be heavy in U.S. stocks. So they were still fairly cheap back in 2010 out of the 08-09 recession. But we began shifting that as prices started to rise in the stock market. Today, you can see in the asset allocation study you did last year, we've shifted to a very diversified model. One of the reasons that you can take advantage of the diversification like this, or the positives of diversification like this, is because our expectations of stocks are so low. There's a whole lot of other assets that can compete with stocks in your portfolio to generate returns, mainly in that real estate real return area. So our expectations, or RBK's long-run expectations for real estate and real return, look a whole lot like their stock expectations. So you just don't need to take the risk in that single asset when we can earn similar returns after fees in these other places. So you can take much more advantage of that diversification effect. Now, 40% on stocks is fairly low. The peers are coming down to these same levels. We're a little bit lower than most, we think, right now, or many anyway. If we all came to work tomorrow and the stock market had been cut in half and RBK was starting to see 9 or 10% returns out of stocks, we might call you together and ask you to take another or look at a different asset allocation if we thought we could get higher rates of return. But for now, the ability to take advantage of a more diversified portfolio just makes a whole lot of sense, particularly with stock prices and bond prices where they are right now. So we've really shifted you over the last 7 years to a much more diversified portfolio. We think that'll be to your advantage when we do get a recession and prices really drop. If you flip to the next page, we can take a look at our basic strategy, which is on the bottom half of the page there. You've already seen this. We've talked about it a lot. We're pretty much there on diversifying equity exposure, going down below that 40%. I would be a little surprised if we could see how to do that in an asset study. So I think you're there. We're really generating a lot more income than we were back in, particularly after rates had fallen in 13 and 14. We're generating a lot more income in this portfolio. That's really an elixir against volatility. So it'll really help you when stock prices start to decline. And of course, the downside protection and crisis mitigation, which you're seeing that across the portfolio, all your asset classes have moved to things that diversify us away from cap-weighted benchmarks, that diversify us into income-producing investments, all those things that provide that downside protection. I appreciated the last speaker's comment about, protect your downside, the upside will generate itself. I don't quite go with the latter part of that. I think we got to pay attention to how we generate that upside, but I definitely agree with taking care of that downside, particularly at this point in the economic cycle, which we just showed you. The last thing I'll say about this report before we have any discussion or questions on it, pages 278 to 282 are the special topic sections. We talked about 282, where we are in the economic cycle. The mid portion of the report details some of the asset class plans. So, Mr. Chair, as we have a discussion, I've got all the asset class directors here with questions about the specific asset class plans. Or we can talk macroeconomy or the broad strategies that we have. I think really to close out on this particular report, I guess let's look at 282 before we get to the end here. That's this is an important chart. We added it to the tail end of the CRO report. You're familiar with these efficient frontiers. You can see the bottom one is the one we're working with today. This is just based on RBK's long run risk and return and correlation assumptions. That shift that you can see is something that we might expect if we got into a recession and stock prices drop 35–40%-ish. We could see the yield, we could see the efficient frontier shift up to the right a little bit. We want to stick with that shift. So I think we've got ways to do that. We're coming with the liquidity report to sort of show you how we can do that. If we do get a big sell-off, if the recession comes and we see prices fall on assets like they normally do, see a curve shift like that, we definitely want to follow it. Try to take a little bit more risk, shoot for those higher rates of return when prices are down. You were one of the first folks to start cutting your return assumptions among public plans. So 2010 or early 2011, we cut from 8.5 to 7.5. 14, we cut from 7.5 to 7. You were one of the first plans to be doing that. We'd like to be one of the first plans to start raising it again, because that would mean we're shifting out with that curve at better prices in the markets. So with that, Mr. Chair, any discussion that you'd like to have, answer any questions, I hope that
Okay, I'll open it to the council. Similar to what has been said, similar to what we had seen before. It ties in with, of course, what we've heard from RBK, update. Months ago. Tim, you have a question?
Ben, since we've been protecting the fund, so to speak, over the last 7 to 10 years, when do we start chasing returns again? When did we become aggressive? And I mean, I've looked at some of your numbers, and when you look at U.S. equity and non-U.S. equity from 10 to today, we should have kept them that way, based on not going to real estate. So we've been very conservative in a great growth period. When do we now start chasing returns again?
Just if I can get to the right graph here, Mr. Treasurer.
I mean, I fight with my broker all the time because he says, based on my age, I should be moving more money to bonds. And I keep saying, but I'm not withdrawing any money, so why would I want to change my allocation to risk, from risk to, I mean, when did we, this is supposed to be for generations to come. I mean, when do we quit protecting and start growing again?
Sure, you bet. Let's flip to 262. I would argue with you, we didn't get defensive until 2014. So if you look at the asset allocation in 10 and 11, that's still that's a pretty aggressive asset allocation. You would see that as.
But when you look at 17.
We'll get there. If you look at 10 and 11, though, that's, particularly 10, is an above average risk level for large public funds. Like, I'd even argue that 11 would have been an above average risk level. So not until stocks really got highly valued in 14, that showed above 25, did we start really talking about defense. And since 2014, 15 and 16 were weak years in the market. 17 was a big surprise to everybody. 20% return in the stock market. Nobody expected that. We've had only 1 year since 14 that's been very good in terms of rates of return. Every other year has been fairly weak or about average. So I think you've done the right thing in terms of your timing. We don't try to time these markets, but in terms of your strategy, when markets got overvalued, we started moving defensively. We've only had 1 year since. It's been a good year for us. But to really answer your question, when we have the next recession, and they always come, prices always drop. We very much take a hard look at how to take advantage of that. I'm going to deliver a report to you we call Liquidity 2.0. It shows you how we can take advantage of of cheaper prices to add to put on the risk. Most funds now, well, the average fund is around a 12.5 or 13% volatility. The most aggressive fund is probably around 16 or 17. We'll show you how to move out to 16 or 17 very easily without big changes in your asset allocation to be at the higher end of the risk range of what public funds typically put on, but at the right time, after we've gone through a recession and prices are low. So we'll deliver that report to you in the next couple of months, particularly over summer when we're not so busy, and you're not so busy in terms of activity here. We can talk through that.
I think that's what Vince was trying to show in that last chart on 282. When there is a correction, you're in a position to take advantage of that and go into the riskier asset classes.
And then your chart on 265. And when I looked at that, I'm concerned more with whether education's inflation, so to speak, is going to be greater than the CPI, and we're going to be giving less distribution education. So at a time when it's a good time right now because population is decreasing, especially in New Mexico. But what happens when that shifts? And that shift could not be 7 to 10 years. That shift could be 2 to 5. And so here we are, less distributions.
We think, well, with the intergenerational equity model, we have a 1% real growth built into that. And land grant still performs above the 50th percentile. So the 50th percentile we expect, which is what we try to hit, that spreads the risk between the future and current generations in terms of distribution, or economic value distribution. Land grant's performing a little bit above, and that includes 1% real growth rate. So we think if there is inflation in education above the CPI, we've already got a little bit of a cushion in the model to address that.
I do think the liquidity study was one of your accomplishments this year that has informed our planning very successfully. Not only with respect to confidence in meeting our liquidity requirements in the event of a real downdraft, but in the context of having dry powder for when investment opportunities do present themselves in an asset decline.
That's right. And at the next IPOC meeting next week, Charlie? Couple of weeks. Yeah. So next week or 2 weeks from now, they've asked us to address both inflation but also liquidity. We'll talk about that liquidity 1.0 that we gave you. So that model is what happens if stocks drop 35%. Do we have enough money to pay the bills, rebalance the portfolio, meet our capital calls, take advantage of anything that has really fallen apart? It shows that that showed what we needed, and then we made structural changes to the portfolio at your last asset allocation to make sure that liquidity was there. We think it's there. One of the things we'll say to IPOC, and I think I've said to you all, is we've studied a lot of large public plan CAFRs from the 2009, so June of 2009. Just about everyone was underweight their risk assets. In June of 2009, the market bottomed in March. So at very cheap levels of the market, almost everybody was underweight their risk assets. And the main reason it appears is they just ran out of cash. So by the time they made their distributions and they paid their operating expenses and maybe made their capital calls, they didn't have enough money to rebalance. And we want to make sure we can. That's what 1.0 is about.
One of the things that it's really easy to lose sight of, especially in great markets like this, is that when we work hard to say what is the target return that we need to accomplish our goal, that is what we now base our asset allocation on. Not how can we make the most amount of money, because what asset's really on a tear right now. And it's very tempting to say, oh my gosh, look how much money we're leaving on the table. It should have been somewhere else that's on a roll. But that's not what we do. We're establishing a target return. And so our asset allocation is to establish, to make that return, not to try to exceed it because we think we can pour money into a great asset class and see how it goes. So that kind of dictates why we maybe have an allocation in stocks that you say, gosh, why weren't we a whole lot more? Last year was just terrific. Well, that's why. And, but it's real easy to lose your focus on what we want is 7% over a long time.
Other comments or questions? I think, again, excellent work and really lays the framework for what we're doing, and I agree with your comments. And certainly in retrospect, you can always critique that we were in the wrong category. We should have been in 100% equity, right? And, yes.
I would just note, I think to your point, Mr. Treasurer, we actually did look at the difference since 1961 between the CPI, so standard inflation relative to higher education price index. That was actually about 1% for the last 50 years. So I think the assumption that we have built in that 1% cushion very much addresses that.
Yeah. Probably do that. Okay. This is a voting item.
Get understood.
Right.
Based on the recommendations of the Council Investment Committee, SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve the 2019 annual investment plan as memorialized and discussed by the council at today's meeting.
Okay, I'll second that. Are there any further comments or questions? All in favor? Aye. Thanks, Tim. Any opposed? So passes 100%. Thank you, Vince. And our next item is performance.
So just a few comments, Mr. Chairman, very light comments, and I'll also go over to Marcia and Matthias if they have others. But your May report, is that your place? It's not quite complete yet. Land grant and severance tax numbers aren't in there yet. Probably next week, maybe later this week. We'll see those, and we'll try to ship that report out to you as soon as we can. Still, sort of normalish looking returns. That's down from very good returns that we've had. You can see the 3, 5, and 7 are all sort of in that 7% range, still a little bit lower on the 10-year. The 1 year's starting to come off the boil. That was really all about, just what the Treasurer and I were talking about, 2017 being really the only good year since about 14 with investment returns, and that's what's really holding a lot of these numbers up. That's on page 2, I'm sorry. If you flip back to page 1, we made a shift to the interim targets here recently, and you can see the differences now are fairly close to those targets, particularly in the equities. As you recall, we were getting a little bit close to your 5% tolerance limits there, but with the interim target change, we're back to very low deviations. None of those deviations, maybe with the exception of non-core, would we have any active concern about. Really when you try to trade to get very close to your targets, you wind up spending a lot of money and transactions costs that sometimes you don't get back in investment gain by making that switch. So 2 or 3 point deviation, we don't worry about when we've got 5% ranges. Starting a little closer to that 5% range, we'll start becoming actively concerned and involved and be more willing to spend money to make the changes. We are in the search in the non-core fixed income area. BART is to look for investments there to try to bring that number up. Very likely we can fund that with core fixed income investments and start taking that number down a little bit as you can find it. But severance and land look very much the same in terms of their variations, so we can expect similar returns from these asset groups. The main difference will continue to be the performance of New Mexico investments between those two. With that, let me turn over to Marcia and Matthias if they have other comments.
I'd hate to take you back to your book, so I just wanted to make a comment about April that you don't need to go back to your book about, but a question came up at the CIC meeting. At that point, we have the page where we can look at scheduled investable assets for some of the other funds other than the land grant and the severance, and it was noticed that all the funds had investment gains for the calendar year to date with the exception of the tobacco fund. So the tobacco fund is going through a transition, that was part of it. But remember, the tobacco fund is a 65% equity, 35% fixed income portfolio. It does not have the advantage of having those alternative asset classes. So that affected that return, calendar year to date return, because it was a 65-45 or 65-35 portfolio. Again, to your comment about having diversification within your portfolio, certainly it's just a calendar year to date, it was just 4 months. But having fixed income that was negative and equity that was pretty flat for that period brought that tobacco fund. It was stood out because your other funds had slightly positive return, but the tobacco fund was negative. Another point you might have seen in the April report is something that Matthias pointed out at the CIC. We actually saw a shift in the Severance Private Equity Fund did better than the land grant private equity assets, and there was a boost for that month, and kind of a one-time thing, I think, for the private equity in Severance. So I just hated to go backwards instead of forwards, so I thought it was given the discussion today to talk about a 65-35 portfolio.
So I have a trivial question, but I always like to simplify the numbers. I'm wondering why we have a CYTD column. Our focus, do we need it? Does anybody really care?
Well, it made the point today.
I heard that. I was sorry to hear that, but I would love to just get rid of some columns, and that seems one that's pretty unnecessary, because our focus really is month, quarter, and fiscal year, and then the yearly performance.
That's completely up to you. Some people like to see calendar year to date, because that's what they read about in the paper, that's what they hear on the radio. You're more sophisticated than that, so it's really up to you.
I think the calendar year day is important because that's the value that is taken from by the state for operations. It's based on the 12/31 number, not the fiscal year.
They take the 12/31.
So, I mean, I think that's important because then we can say, okay, so far this year, we've made 1.39%. You know, I mean, that's the number that the legislature and executive is probably looking at in terms of what, of course, they're probably looking more at the hard dollars.
Yeah, but of course, it's a 5-year spread, so it's really not precise.
But I think that's the number, I don't know.
I don't know.
I like it there because that's the political end of it. And I understand what you're saying, just from the funding issue.
I mean, I don't look at it, but anyway. If
It's your call. We can do it however you like.
well, if Lee finds it useful, it's not a big deal. But I think it's easier with less numbers to focus on where the changes are and where the things are that we should be interested in. I always push for one less decimal point.
I know.
Nobody ever listens to me like that. That's what years of accounting, never getting things to balance. So. Okay. Marcia, do you have anything else?
We're good.
Okay, very good. We have the private equity reporting items, that's information only, as far as I'm concerned, but certainly open to any questions anybody might have. And then, Steve, I think we move to your report.
Thanks, Peter. Over the last 12 months, the SIC has distributed to the state $899,568,000.
How come we missed the $5?
You're going to see a nice increase in these numbers. As a matter of fact, if you look at the one-page report that I've given you under distributions, you'll see we're projecting for FY19 beginning July 1, 968 million. So stand by for increases. West Texas Intermediate, as of close yesterday, was at $68.04. And our NAV at 23.741 billion. Going back to the one pager that I try to give you each month, you'll see that we had no meetings in July. We're showing you the 4 meetings that we do have scheduled for August. Lynn will be reporting on the governance committee meeting, I think briefly today, and then in more depth in August. That meeting, as all of you know, will occur immediately following our SIC meeting. I'm going to ask Brent, if he will, to comment under operations on a new hire that he has achieved. We're very pleased with that. Also on the one position which we are continuing to search for, number 2 under C. If you will, for a minute, please focus on C3, land grant inflows from the state land office. And take a look at April of this year as opposed to May, where those inflows have increased from 59.3 million to 63.9 million. And as Charlie reported in the weekly last Friday, the oil and gas lease sales at the state land office have hit new record revenues. June revenues have increased the FY18 number to $107 million, breaking the 2012 record by 5 million. All of you will remember that West Texas Intermediate hit a high of $145 a barrel in July of 2008. That does not impact these numbers, but I just thought it was an interesting observation to remind ourselves of that, as opposed to the $68 we're looking at today. In the Oil and Gas Journal recently, we noticed that the U.S. rig count had dropped by 7 units. However, New Mexico was unchanged with 93 active rigs. The national count up 111 rigs over the year. I just think it's interesting to keep those things in mind. I'll ask Brent in his report to comment on our JP Morgan custody contract. Moving to external relations, I think you'll find this very informative. We met with Investments and Pensions Oversight Committee, IPOC, for those of you listening on the webcast, on June 7th. We'll meet with IPOC again on July 11. And we have several follow-up items that we'll be discussing with them. I'll ask Charlie to comment on those here in a minute, as well as on a new money strategy that we previewed with IPOC in the June 7th meeting. And I think it would be helpful for Charlie, if he will, to go through that in a little bit more depth with us. Also might just comment on our rainy day fund, Charlie, when you get to your report. We have our next Sovereign Wealth Fund collaboration call with the participants on July 18th. Charlie?
Thanks, Steve. Mr. Chairman, so there is a memo in your reading booklet on page 310. There's also a hard copy in front of you. Don't have that. This is a memo based on some comments and also some discussion at IPOC regarding growth of land grant and severance fund distributions. And so we did a little bit of analysis internally just to take a closer look at this issue because it seemed to resonate with the committee. It certainly resonated with the Albuquerque Journal and their editorial board, which said it makes sense to look at the new revenue being created by the permanent fund and perhaps earmarking that for legislative priorities rather than the idea of increasing distributions out of the fund. So go after the new money that the engine is creating rather than the engine itself. The memo highlights a couple things that I'd like to walk you through. Specifically, it takes you back over the last 2 decades regarding the amounts
being distributed by the permanent fund. The thing that stuck out the most is out of those last 2 decades, only 2 years, year over year, did the distributions out of land grant fund decline. Both of those were caused by a decrease in the distribution rate that's caused by the 2003 constitutional amendment, stepping down from 5.8% to 5.5 and 5.5 to 5.0. Every other year, including 2008, when the funds lost more than $2.8 billion in value for the land grant fund. The 5-year rolling average tends to smooth things out, and even in that awful year, year-over-year distributions increased. It speaks to the resiliency of these permanent funds, and it also highlights the fact that we are giving a tool to the legislature to address the priorities that they identify. Most of the money coming out of the permanent funds is somewhat untethered. Land grant fund, the big chunk that is set aside for schools, $635 million in the fiscal year that starts next month, is unearmarked. The severance tax fund, none of that money is earmarked. Land grant fund distributions, all you have to do is, you can put that to educational priorities. So I think we have tried to get this message across that the funds are an economic engine or revenue engine for the state, and they're producing quite well. So I believe this is an area that we want to visit again in July, when we visit with IPOC, and certainly we like to hear any kind of input you have as council members in this regard.
This is excellent communication, and it's simple and clear. And it makes the points very effectively that the five-year rolling average, the prudent level of distribution as a percentage has allowed for these distributions to be maintained, has facilitated our generational goal. And I think the highlighting in this particular presentation that only $112 million of our distributions are specifically earmarked to the beneficiaries designated by the land grant fund. The rest is all, I guess it would be accurate to say, generically earmarked for education. But the discretion as to how that money is spent, at what level, if it's pre-K or K or higher ed, is within the legislative branch to determine and to set. And I think that's a remarkable insight into how much flexibility the legislature does have to meet changing priorities. So I'd be very interested to hear from some of our council members with legislative experience as to whether this is, a productive conversation in light of all the other conversations we've had in past years about changing distribution rates, which have a very significant downside.
Again, the political discussion or rationale is totally different than a financial discussion or rationale. Because things are said for political purposes, which sometimes different from what's reality. And, they're going to look at this and say, well, we've already got the new money. So Steve's argument that says, well, we can just put the whole new money into education, they've already got that money. What they're interested in is what else should you do for us? And see, it just becomes a show game. It's the same when Richardson raised the whole thing and said, we're going to put so much money in education. Well, they do is just take it out of the left pocket and put it in the right pocket. It's just, it doesn't, it's no increase in funds. It's, well, this is supposed to be more money for education, but it's not, because the legislature just takes money that they were already giving to education. They lessen that because now they got the new money. So you just have this it's a gamesman, more of a gamesmanship financially than you might have in, a corporation or something that's trying to do things differently. So the fact that what they're gonna look at, I mean, the real issue is, can we sell the point that by leaving the money alone, we're gonna give them more money? They already have the discretion to do what they want with it. Their issue is, how much more money do we need this year to buy the boats that we think we need next year? I mean, that's really what they're looking at. And so, and you've got them in this situation where, it is a little bit, and my perspective, it's a little bit partisan, is if we take money out of the severance taxes to buy projects in our community, that's what we're sent up for, and that's what gets us reelected. And one side out says, no, we should leave that money alone and leave it in a permanent fund. So it's a matter of the individual legislators, their district, do they think they need projects? Do they think they need to increase the budget in certain areas? Do they need to, and it's all based on electioneering. It's rather than, that's the reality, that the political deal is a little bit different. I mean, this makes sense to you and I as we look at it from a financial lens. It makes a lot of sense. But it's not the political lens.
Well, thank you for shining a spotlight on that political lens.
But you can see it up in Nashville, it's all about votes,
Because it should be about public policy.
But it's not.
And we're not in the business of making public policy, the legislature is.
It's a matter of control. And that's the difficulty. I think what we need to focus on is, how do we keep the severance tax money coming in? Okay, last year we had $32. I don't know what we're gonna have this year, Duffy.
More than 32.
More than 32, maybe 33. But we're not gonna get the sweep bonds, you said, right? You're gonna sweep, so we're not gonna get that. So again, if the legislature, and Duffy's telling me that Moody's wants to have 17% reserves, where traditionally, we had 10. Johnson came in and he built the reserves back up from where we had the real dip. He got the reserves up to 10% or something. Everybody think, hey, this is great, 10% reserves. Moody's rating was good. Then we had this situation in 2008. Things dropped down, and now they want 17% reserves. Well, that 17% reserve they want is keeping it from coming into the permanent funds, because they're going to keep that on the other side of the books. So that stifles what we're able to produce on return, because I imagine that's probably money that Treasurer Eichenberg invested, probably a lower expected return than 7%. So, we kind of shoot ourselves in the foot at a certain point. Why do we worry about the rating? Let's just get the return and not the rating. I'm kind of on a rabbit trail, but.
No, I appreciate your comments, and I think it's incumbent on us in this distribution and prudent distribution of discussions to communicate clearly with the public. And I think this goes a long way to doing it. So I appreciate the work. It's an arduous argument.
We'll see, what I would like to see in the next report, and I don't know if we're there yet, Carrie, but show the 2018 actual contributions, but to show the fiscal year 20, I sure would like to see the fiscal year 20 projected distributions at over $1 billion. See, because then when we can show
that's real money,
we're getting you $1 billion, leave us alone. That sounds a little bit better than 900. The number just forces it.
Mr. Chairman, yes, and Lee, to answer that specific question, if we were to close the books today was December 31st, next year in fiscal year 2020, we will distribute more than $1 billion. We have a little bit of wiggle room as far as we could lose $1 billion and still do $1 billion if it was applied equally across the land grant section. But we'll keep doing kind of up to date on those numbers as far as what those look like. We can get you that information.
Okay. We're trying not to get too far out in front of things, but now Charlie's giving a good perspective.
Well, that $1 billion is 25%, so we've only earned 1% so far.
in the calendar year to take.
Yeah, that's right.
We only earned about 1% so far this year, through May. So it could be a -5.
Charlie, weren't you going to be responding to somebody who asked for an analysis of what our distributions would be now had they not raised the distribution level in prior years?
So we've been tasked by a couple different legislators and committees to kind of make that projection. And so the basic number is, if we had not increased the distributions in 2003, which caused another $750 million to be dispersed from the land grant fund. If we had never done that, today that amount would be about a 1.5 billion more. And that number grows just over time because we have lost earnings that we can't capture.
What amount would be 1.5 billion more?
The land grant fund. would
The
be
size of the fund.
Size of the fund would be 1.5
But how much
billion
would the distribution,
billion more.
and the annual distribution would be what?
Right, 5% of that over time. So it's significant.
And on the severance tax side, that number's astronomical in terms of what's happening there.
The lack of inflows, if you look at these, I mean, you can tell which fund is healthy, which one is not. Year over year, I mean, just back of the envelope numbers, we could maintain the distributions from the land grant fund, even if we were to lose 23% of the land grant fund, it would still, year over year, maintain its same distribution. Severance tax fund, we can only take about a 15% hit. And at that point, it starts, the 5-year rolling average does not save it from distributing less.
Okay. I think we're ready for Brent's report.
Yes, and I'll be.
Let me just ask if we could get, on the handouts, if we could get electronic copies,
But it is in your.
Sure, and
that's fine, and even the new,
we'll make sure that you get that.
Oh, yeah, so I think it's Brent's turn.
Mr. Chairman, I'll be as brief as I can. I just wanted to point out a couple things on page 319. This is an overall budget schedule. I think I mentioned last time, and I'll mention it again. We did go out for a bar, 5% bar. So we would have enough money for contractual services through the end of the fiscal year. That bar was approved, I think it was June 4th. And over the last week or so, as you probably noted, the market has come down a little bit. So that's also giving us a little bit of breathing room. And then if you go to page 343, I just wanted to, because I think it's important, on the very first bullet there, I note that the monthly contribution from the state land office is $63 million, which is over 4.6 million over the prior month. What's really telling is if you look at the contribution from the state land office last year, it was only 42 million, so we're up over 50% as far as contribution from the state land office is concerned. And then on my notes, I did want to point out that we are in the process of completing I should say CLAs in the process of completing the agreed upon procedures for the third quarter. And hopefully we'll have that report out by July 2nd. I'll furnish that to everybody after it's finalized. Steve wanted me to mention, we did have, we lost a person in December, one of our accounting coordinators. We have hired someone who is starting on Monday. His name is Karthik Mohan. We're very fortunate to have gotten him. He is actually from India, has some international experience, which is kind of nice. He's working in Albuquerque now, and we're very excited to have him on board starting on Monday. It's been a long process to get someone that we thought would really work out in that position because of the alternative investments. We have expectations maybe a little different than maybe a recruit that we look for just strictly in stocks and bonds. So we're very optimistic there. And then he also wanted me to mention the JP Morgan custody contract. We're in the process of getting that signed and returned. As I pointed out last time, it's been a process. Evan's worked really hard on that, and we're happy to get it done. And hopefully, over the next couple of days, we'll finalize the signatures on that.
What's the cost?
The cost this year for custody service, we're going to be probably right at $2.6 million. You have to remember, Lee, some of those costs within the custody arrangement are transaction-based, some it's value-based. So as our assets have grown over the last 4 years or so, the custody fees continue to grow based upon largely the asset growth. As far as the rates within the contract, those rates from contract to contract are basically the same. We saw no increases in rates, and I want to thank Evan for that. So if we do see dollar increases year over year, it's largely based upon either assets or transactions.
Do we ever go out and,
Bid it?
what's that?
Bid it?
Well, yeah, or at least compare it. What else, I mean, how does the rates we're paying compared to what we might be able to gain?
Yeah. That's probably something we can do in the future. I do want to point out, I mean, as far as like changing custody services, I think you want to keep everybody honest, but it's quite a process to change from one custody agent to the other. We have hundreds of accounts, but I mean, as far as looking at rates, we'll continue to look at those and make sure that there's not something better out there available. But at this point in time, there's no increase over the current contract.
I would probably suggest that they know it's difficult. And therefore it has a cost. And I'm just saying we need to try to make sure that we're getting, because basically you're wanting us to approve, well, we should approve the $2.6 million contract at some point. And it's nice to know what the option could be. Even we might say, well, it doesn't make sense managerial wise to make a change, but at least maybe that's some leverage that you're negotiating too.
You know, Member Rawson, I threw out the $2.6 million amount only because I track it on a monthly basis. It's an estimate. It might very well be $3 million.
Sure, but I'm just saying it's not a $50,000 contract.
That is correct.
And I don't know if that's something RBK can't maybe kind of gather some statistics as to what some of their other clients are paying, just in general.
Blind requests.
Yeah, and we could also compare this with what other New Mexico investing entities are paying because they use other custody agents.
And I'm not suggesting we change, I'm just suggesting we
I
make sure we keep
understand
everybody
your
honest
point. I understand.
and competitive.
Mr. Chairman, I would note that as it relates to custodian, peer comparison is likely not highly relevant because the complexity of what a plan is the primary driver of the cost. So typically what we do is an RFI to say, these are our requirements, what is the cost from other providers relative to an assessment from another plan that may not be comparable.
Guys, are there other providers? I know that Arkin is used to be present.
It's much smaller.
Much smaller,
As we look at, I would say, the large public fund space,
Right.
there's probably 3 or 4 dominant custody banks that have 95% of the business, and that's because they have the scale and the resources to serve somebody with the scale such as this fund.
I just also add that if you have a team that's working with a custodian, it's hard. You can talk to them about reducing fees, but it is to me, they virtually do very similar things. But if you get the wrong team, it can be very painful. And if we've had people that are unhappy with their custodian, a route that we sometimes say is let's change the team that you have, instead of changing your custodian, because it can be very painful, but that doesn't mean you shouldn't be doing periodic bus checks at all.
We've been through it once. We changed from Northern Trust to JP Morgan. There's also one other thing, Brent, I appreciate you mentioning, and that's the risk management component of what they're gonna offer us.
Yes. One of the things that Evan did effectively, and I appreciate this, is the risk management component this year. They threw in that as at no additional cost, which we really appreciate, which is probably $100,000 plus. And also, I should point out, I'm very in tune with what the other agencies are doing. I just had lunch with a person from ERB. I'm constantly filling out, how the custody arrangements are working generally, and I've worked with various custody firms, and as she pointed out, they're a lot the same. As she also pointed out, getting that team that works for you, is very specialized, is very important. And you can make a change, and it's probably going to be 2-3 years before things are kind of stabilized back to where it was before the change was made. So, but I do understand your point as far as cost and making sure what we're paying for it is comparable to other agencies and other agencies.
And we didn't have an audit committee meeting this month, so is there an update on our change of accountants? Very, very brief update.
All that I have is we have a motion that is in the material. We just need a motion to approve the firm formally. Carrie has assisted on this. This contract for audit services not only goes through the Office of the State Auditor, but the Contract Review Bureau at DFA. The final thing that needs to be done is the motion. As we reported last time, this did go out to RFP. We had 2 respondents. Moss Adams is a firm that we've used before. We had another smaller firm out of Idaho that responded as well. We do have, and I provided Duffy some information on this, a team that's much different than the team that we had before. We're optimistic that this is going to work out well. I did find out from OSA, if we decided that this firm wasn't going to work, it'd be 2 years before you could go back to a firm like CLA that you've used before. But in a year's time, if we decide that Moss Adams is not working for us, we'll just put it out to bid again.
Good. Yeah.
Could you give me an update on the arrangement that we have on fees, where we were going to have somebody to take a look at our fees, and I knew we were going to do a lot of input before we.
I appreciate that question. Bruce, would you be better suited?
Yeah,
You're a little bit more on the
I'll
ground.
give you a quick update. So it's Colmore. Colmore has been very active with this. We expect, they found interesting things, a lot of things we knew about already, but they're not complete. They expect to be finished in early July. We'll be online in early July, and we'll have access to all of their data. We'll be able to compare form billables across all the private market assets. So I would expect there will be a formal report for August.
Great.
At which point we will give you a more detailed breakdown than I think is generally seen. I was recently contacted by a large pension fund who was thinking about using coal, which is very interesting because they didn't know of anybody else doing this either. And this is the cutting edge type accounting practice. I think what you're going to see in the next few years, a lot of pension funds are going to come along to do the sort of thing that Colmore is doing now for us.
Are they getting the level of cooperation that we had hoped that they would get from our managers? It's a pretty intensive, overwhelming process that we're running on managers. They are.
Yeah, I've heard a lot about it being intensive for the managers. I don't know, I've got a Fidelity account, they're able to give me a lot of information very quickly, and I don't have anywhere near what's invested in my Fidelity account, which we have invested in these private equity accounts. So when I get that pushback, I'm very suspicious. We have tended to get pushback from firms which we think are probably less professional about it. Our newer funds tend to be better at it. With our bigger investments, they tend to be more state-of-the-art. Our earlier funds from the Aldous period tend to be worse. So I think, which is what we would expect. We have been doing a better job of this since 2010 or whatever.
But we're getting cooperation.
No. Sorry. We are getting cooperation from about, at this point, we have about 65% return rates on their questionnaire. We have nearly 100% access to their financials, but they're looking for more information than that. They're looking to dig down into the numbers, find out what it really looks like compensation to managers. And for that, you need cooperation, and we've gotten it from about 65% managers.
So again, Evan, as we contract with new managers, I know you've heard this question many times.
Yes.
At what point in time do we need to send a letter to the 35% and say, hey, it's our expectation that you comply with this request?
Well, we are now on the second ding letter from Colmore.
Right, but I mean, this body here.
You guys, we were gonna go with the Brent route, next, on the third approach. But I think if you guys want to make an approach.
If it gets to that point, just another tool, so to speak.
Typically, we've had pretty good success. I lean on them pretty hard and will continue to do so. And I've kind of learned that through, the audit process and getting back confirmations and other things. Generally, I think it's going probably a little better than I expected, but there's going to be some follow-up letters that need to go out, and they're just going to have to understand that we're not backing off. And as soon as they get there, I think hopefully it will work well.
We need to send Lee someplace, I'm sure he's really happy with that. He's a heavy here, so.
I think, I think that when we're getting, we look at this as a real red, I look at it as a red flag when we're not getting this information. Because truthfully, it really should not be taxing their back offices to get this information to us. The idea that it does just strikes me as absurd. So it strikes me as a red flag when we get this, and I think we'll be pursuing it. But it might be something, if Brent's approaches don't work, maybe we don't come back.
Yeah. And I would point out, as I think he mentioned, and I think Marcia helped out, we're getting other funds asking about these services. And this is not going to go away. I mean, I think we're on the forefront here. I think the information is going to be good. I think it's going to be useful. And these funds need to understand that this is just the start. I mean, we're at the forefront, but there's other funds that's going to follow suit. And they might as well realize that and provide the information that's needed.
Yeah. Lee?
Based on the recommendation of the Council Audit Committee and the SIC staff, I move that the SIC approve the contract with Moss Adams LLP to perform the audit of the State Investment Council financial statements for the fiscal year ending June 30th, 2018, and the completion of agreed upon procedure reports for the 4 subsequent quarters as discussed and reviewed and memorialized by the Council Committee.
Second. Thank you. Any discussion? All in favor? Aye. Any opposition? So it passes unanimously. Thank you very much. Thank you, Brent, for the report. And we got to leave us on the agenda. Old or new business? Hearing no old or new business. Our next meeting is August 28th. Is there any public comment? Is there a motion for adjournment? God, thank you. I second that motion. And, we're adjourned. Thank you all very much. We have a vote to adjourn 6-1. Governance is meeting now.
And we can vote it.
Thanks, Tim.
Sorry I wasn't there, but
You should not be.
thank you.
So we can just do that.
You're adjourned, Chair.
We are adjourned, yeah.
We do have a governance committee meeting, we'll be able to accelerate the timeframe. We'll start at 11:30.
Right.
And all the ones like always. Biological.
Oh, okay.
Chit chat.
Yeah, do you have this? How much you want to see?